All right, folks, I'm ready to get started. Welcome back. Welcome to the second to last lecture of the course. As I mentioned last time, as I hope all of you are aware, we are not meeting next Thursday, a week from today. We have only one lecture left for the course after today, and then we will be done. The paper, of course, is due the next time we meet. All of you know this as well. One quick reminder, though, to submit both the paper and the hard copy and the digital copy to me. And again, you can submit the hard copy to me under my office door, in my office hours, or in class next Tuesday by the end of class. And beyond that, it will be considered late. If I don't have both copies, it will be a big, severe deduction for you on the paper. Mini papers, I just don't have time right now to go through and give credit for everybody's mini papers, so it's going to happen by the time you get your grades for the paper, which should happen right before the final. Got a lot of work to do between now and then, grading all your papers on top of papers from my other two classes, so it's a lot. I'll definitely be done. I've never missed the deadline of the final. So by the time the final comes around, you will have at least that information, but don't expect it any sooner because it just takes me forever to do all that stuff. Alrighty, are there any questions about anything before I move forward with the lecture today? Yeah. No, it'll be a normal size exam. Yeah, but you will have the extra time, the full 2 hours to do it if you need it. The final exam. Okay. Yes. Yeah. Other questions? Alrighty, then let us jump into the material for the day. We are focusing on chapter 15, capital, and then we have one last chapter. I think it's chapter 16, and it is externalities, dealing with external costs that markets may incur on non-market participants and how we might be able to deal with that. It's one of the cases of what's called market failure, where, again, the markets themselves aren't able to efficiently allocate our resources in a way that benefits all of society. So one case of market failure is the case of market power, where the firms have the ability to set prices above marginal cost, limit mutually beneficial transactions, and that leads to deadweight loss. Another case of market failure is when there are external costs to transactions, firms are trying to maximize their profits, but in the process, they're minimizing costs by dumping their excess waste into the river next to the plant where they are operating. So pollution is a clear example of an external cost. And so in economics, we try to sort of formulate ways of dealing with these external costs. There are theories that suggest that the private market, the invisible hand, can deal with these situations, given that there are a limited amount of transaction costs involved in doing so. So that's basically the core of the next chapter, kind of examining that idea and seeing how it could play out. The third case of a market failure is that the good that's being allocated in markets is not serviceable by markets. So the goods that we've been talking about are private goods, and private goods have two defining characteristics. One is that they are excludable, so you can stop people from consuming them. Unlike, let's say, fishes in a river. If it's a public sort of area where there's a river and there's fish, nobody can be stopped from fishing in them, and so that is not non-excludable. And another characteristic of private goods is that they are rival in consumption. So, if you consume a fish, somebody else can't consume the fish. That's not the case with national defense, right? Your consumption of national defense does not preclude me from also consuming national defense, essentially being protected by our armed forces. So those are cases of either public goods or common resources, or or artificially scarce goods, which we aren't going to cover in this course, but that is the third case of market failure, and it's just something you should be aware of, like the fact that everything we've been talking about pertains to the allocation in markets of private goods, and that when you don't have those characteristics, non-excludability and rival in consumption, then you don't have a private good. You have either a public good, a common resource, or a artificially scarce good, in which case we have different approaches to deal with that. In all cases of market failure, the government should play a role in mitigating those situations. We talked about how governments might regulate natural monopolies at the most extreme case, but also the Federal Trade Commission and the the Justice Department are tasked with monitoring industries to make sure that power isn't concentrated too much, so that too much market power doesn't wind up in the hands of firms that then could lead to too many mutually beneficial transactions from not occurring. So just notions that like there's no role in government and markets are incorrect. So you'll get like extreme free market thinking economists that will claim that is the case, and that is generally incorrect. And you should understand that, and you should understand that market failure is a reason for there being a role for governments in markets. But we can't simply have a blanket sort of approach to these things. You have to consider it case by case. You have to be very specific and very precise, because governments can get in the way of markets working efficiently as well. Like it's not a perfect scenario. There has to be a lot of thought put into those approaches. Anyway, that's important stuff that needs to be talked about. We'll talk about one more case of market failure on Tuesday, but today we're going to talk about the second input into production that we've been talking about, which is capital. We talked about labor on Tuesday, and so now we're going to talk about capital and how like the price of capital is essentially determined. So we'll talk about the relation between financial capital and real capital. Financial capital being what all of you have likely been studying. Those of you in finance understand how financial capital works really well. So real capital is the resources that we use to produce. Financial capital is what we use to purchase those resources. So we'll talk about the relation between the rental rate, the price of capital we've been assuming, and the interest rates in markets that, again, will be a component of how the rental rate is set. And then we'll talk about the criterion for buying a capital good, which is, of course, going to be a question of benefit versus cost. So we'll be looking at overall benefits and costs to purchasing a capital good. And then we'll briefly talk about the market of stocks and bonds, which most of you already understand, but we'll likely touch upon some topics that you may enjoy because you actually know what I'm talking about this time. All right, chapter 15, capital, financial capital and real capital. So financial capital, of course, is money or some other form of paper asset that functions like money. Real capital is productive equipment that generates a flow of services, also called physical capital. Again, that can include machinery, buildings. We refer to capital as a factor of production. We're, of course, generally talking about real capital, not financial capital. When people talk about the capital market, they generally are talking about the market for financial capital. So it's just important to have that distinction in your mind. So let's look at the demand for real capital. The input that is used to produce that we've been considering as the second main input into production. So the theory of the individual firm's demand for labor applies without modification for the demand for other inputs. So in the short run, if the firm can acquire the services of as much capital as it wishes at a constant rental rate of R, then it should employ capital up to the point where if it is a firm that sells their goods in an imperfectly competitive market where they have market power, then they're going to look at their marginal revenue product, which is equal to the product of the marginal revenue of selling an additional unit in the market. Well, of selling an additional unit in the market times the marginal product of capital, the extra amount of output that can be produced by employing an additional unit of capital. So again, that's a short run condition. We know the long run condition is that the firm chooses their input levels at the point where the marginal products per dollar spent are equivalent across all inputs, which is something we derive with the ISO cost and the ISO quant framework. So they set their marginal revenue product equal to the rental rate to choose the optimal amount of capital in the short run if capital is the variable input. And if labor is a variable input, then they set their marginal revenue product of labor equal to the wage, which is the price of labor. If the firm happens to be a perfect competitor, so again, this pertains to a firm that sells in a market in which they have some market power. So again, they face a downward sloping demand curve. So the extra benefit of selling additional units is their marginal revenue, which is less than price, as opposed to a perfect competitor in which they set their price equal to marginal cost because price equals marginal revenue, because they face that perfectly elastic demand curve. And so each additional unit they sell generates a marginal revenue of the price. They don't have to, again, lower prices on additional units as they sell more. So if a firm sells in a perfectly competitive market, then it should look at the value of the marginal product of capital, and they should set that equal to the wage, which is equal to the price of the good times the marginal product of capital, and set that equal to, I'm sorry, I said the wage, I meant the rental rate. So again, it's the same condition that we learned in the last chapter, but pertaining to capital instead of labor. So again, the main difference between capital and labor is that labor may become specialized, while new forms of capital, financial capital, are versatile in their use. So when we're looking to sort of expand our sort of workforce, either it be made up of capital or labor, labor will over time become specialized, but capital can be converted to financial capital. Once financial capital has been used to produce real capital, though, the firm's flexibility becomes limited as well. Whereas labor can, at some expense, be retrained to perform new tasks. So once a firm has invested in financial capital, has invested the financial capital to purchase real capital, that real capital may not have other uses if it's very specific to a particular production process. All right, the relationship between the rental rate and the interest rate is what we'll examine now. Again, the rental rate being the price of capital. So consider a firm whose business is to rent machines. So the firm owns some sort of machines that other firms need to produce. Suppose the purchase price of a particular machine is $1,000 and the interest rate is 5% a year. So again, they purchase the price of a particular machine. They purchase a particular machine at a price of $1,000, and there's a going interest rate in markets of 5% a year. To cover just the opportunity cost of the $1,000 that you have tied up in the machine, then you would have to charge $50 a year for the machine in your rental rate. So again, you are a business that has machines that other firms rent from you to produce, and you're trying to figure out what you should set that rental rate at. And one thing to consider is the opportunity cost of the resources tied up in the machine in terms of returns in markets. So the interest rate is, in this case, 5%, so that would be $50 a year as a percentage of $1,000. For simplicity, let's assume that inflation, the rate of change of the overall price level, something you guys learned about in your macroeconomics course, is constant. So prices in the economy aren't going up overall. In general, there will be additional costs as well that you will have to take into consideration by the mere fact that you own the machine. Suppose the machine requires $100 worth of maintenance a year. So that's something that needs to be taken into consideration. So your break-even rental for the year will then go up to $150, the $100 plus the $50 in the interest rate. Lastly, you have to consider the future price of the machine if you were to sell the machine. So you have to consider the fact that things eventually become obsolete. So technological obsolescence is important. The process by which a good loses value, not because of physical depreciation, but because improvements in technology make substitute products more attractive. So obviously, Technology has been developing fairly quickly these days, so technological obsolescence is a big factor for firms in terms of the value of their capital equipment over time in the last like 30 or 40 years. But there is also, of course, some physical depreciation as well. The machines will start to, fall apart over time. If the net result of these factors, physical wear and tear and technological obsolescence, is for the price of the machine, in our example, to fall by $100 a year, so that's the effect it has. It lowers the value of the machine $100 a year. Then the total cost of supplying the machine for the year will then be $250. Again, the amount of interest, the maintenance fee, and the amount of depreciation or technological obsolescence. So $50 in foregone interest plus $100 in maintenance plus $100 in lost value. All right, so that's sort of like the general way of understanding how a rental rate might be determined. Let's let M stand for, well, that's a specific way, sorry, and this now we'll look at the general way. So let M stand for the annual maintenance expenses, expressed as a fraction of the price of the capital good. We'll let delta stand for the physical and technological depreciation, and we'll let I denote the market rate of interest expressed in decimal form. Then the annual rental rate of capital will be equal to the sum of the three. So again, the maintenance fee as a percentage of the price of the capital good plus the amount of depreciation plus the foregone interest. Sometimes a machine will increase in value, in which case this term here will actually be negative, because again, we're looking at it as right now as a cost, and so and these are all costs, so then we're assuming them all positive. But if you're actually appreciating in value, that's not a cost, that's a benefit to having the machine, which means that this term should be negative. Let's do a quick practice problem to sort of pin down how the rental rate might be determined. So suppose the price of a new car is $15,000. If the rental rate is equal to 5%, maintenance costs are $900, and depreciation is 20%, what will be the annual rent for the new car in dollars? All right, so again, the rental rate equals the rate of depreciation plus the nominal interest rate plus the maintenance cost percentage of value. We've got the rate of depreciation, which is equal to 0.2, the nominal interest rate, which is equal to 0.05, and the maintenance costs are 900, but we're looking at maintenance costs as a fraction of the total price. So 900 over 15,000, which equals 0.06. So the maintenance cost is 6%. The rental rate is therefore the sum of these three, which is equal to 0.31. So the rental rate for this car is 31%. Times the actual price gives us $4,650 is the actual price that will be charged for the car. All right, so that's how you determine the rental rate that we've been talking about in this class as the price of capital. All right, let's look at the criterion for buying a capital good. Another factor that sets capital apart from labor is that firms have the option of purchasing capital equipment. Obviously, people cannot be purchased, fortunately. In making the decision to either purchase capital equipment or not, the firm must weigh the benefits of owning the machine against the cost of owning the machine. On the benefit side, the machine is going to bolster the firm's rate of production, not only in the current period, but also in the future. So, again, we have to look at the sort of the profit stream that's generated by the lifetime of a machine. Suppose the extra output made possible by the machine will enhance the firm's revenue by, let's say, R, some amount R, for each of the N years that the firm will own the machine. Suppose further that the machine costs, let's say, M dollars in maintenance fees per year, and that at the end of the N years, it has a scrap value of S. So at the end of the N years, it can be sold for S dollars. Yeah. Don't assume anything that wasn't stated. Lastly, suppose that the firm is given this machine and expects to operate it for N years, at which point it will sell it for scrap. The question to address is, by how much will the present value of the firm's stream of profits go up by purchasing a capital good? So that's essentially what needs to be addressed, like the overall benefit to the overall cost. It's an either-or question. Should I buy this or not? We don't look at marginals when we're doing either-or. We're looking at overall benefit and cost. When we're looking at, should I buy an additional unit of a machine, then you look at the marginal benefit, marginal cost, and that's when you compare either the marginal revenue product to the rental rate, or the value of the marginal product to the rental rate, depending on what type of market the firm sells in. All right, so in order to figure out whether or not to buy the machine, we have to use present value analysis, which I'm sure the majority of you are familiar with, but I'll do a quick review of it here. So present value is the amount that would have to be invested today at the prevailing interest rate to generate a given future value. If somebody offered you $1.10 a year from today, the question is, what is its present value today? So if you have $1 today at a guaranteed interest rate of 10%, 1 year from now, that will be worth, obviously, $1 plus 1 times that 10%, which is equal to $1.10. Over the course of a year, your dollar would earn that $10 in interest. Thus, when the interest rate is 10%, the present value of receiving $1.10 1 year from today is going to be $1. Because again, the dollar can be invested and it will earn those 10 cents in a return in the market, and therefore a dollar is worth $1.10 in the future. And so the present value of that is $1. So quick formula, present value. The present value of a future value received N years in the future is equal to the future value divided by 1 plus the interest rate raised to the N number of years, where I is the rate of interest, and that, of course, is the opportunity cost of funds. So let's look at how we derive that formula, just for the sake of knowing, for those of you that just memorized it and don't actually know where it comes from. I'm not going to expect you to derive it, but I do want to show you. So consider that there's an initial investment of P naught with interest rate I compounded annually. The investment grows according to the simple rule that at the end of each year, an amount I times S is added to the investment, where S is the value of the investment at the end of the previous year. If we let T measure years and we let S of T denote the value of the investment after T years, then S of 0 represents the initial amount that you are investing today. S of 1 represents the amount that you will have at the end of the first year. So here's your initial amount times plus that amount times the interest rate. So you can, of course, factor out P naught there, and you have P naught times 1 plus I. So that obviously will give you the value of your investment at the end of a year. At the end of the second year, you have this amount coming into the start of the year, and then this amount is being multiplied by the interest rate. So that's where this term comes from. We have a common term here, P naught 1 plus I can be factored out. So you have P naught 1 plus I times 1 plus I. So you basically have P naught 1 plus I squared. Third year, same thing. This amount comes in to the beginning of the year, then you earn an interest on that amount. Obviously, we're looking at compound interest here. So by the end of that year, again, you can factor this term out. You'll have this term times 1 plus I, which is equal to P naught times 1 plus I cubed. That continues to the teeth year, whatever that final year is. In that final year, you're going to come into that final year with some amount from T minus 1, from that period before the last one. And then you're going to multiply that times I to get that final amount at the end of the teeth year. So you're going to have this amount times 1 plus I raised to the first power. You're multiplying this times 1 plus I raised to the first power. Then you add those exponents. You have T minus 1 plus 1, which gives you T. So then the value of your investment after T years is equal to the initial amount you invested times 1 plus I raised to the Tth power. S of T is also the future value, another way to just look at it. And P naught is the present value. So We can plug in PV equals 1 plus IT, set that equal to future value. If we divide both sides by 1 plus I to the teeth power, then you get the formula for present value, which again is future value divided by 1 plus I raised to the teeth power. All right, so back to the problem to decide whether or not to buy a piece of capital equipment. So again, there's N years. You're going to earn revenue from the machine yearly of R. There's going to be a maintenance fee every year of M, and there's going to be a scrap value at the end of N years when you decide you're going to stop using the machine and sell it. The net present value of the stream of returns produced by the machine, including the proceeds from sale for scrap, is given by Gesundheit. So again, your net revenue from the first year, your revenue minus the maintenance fee over the 1 plus I raised to the first power discount factor. So again, this is the amount you're getting a year from now, so you're discounting it to the present by taking into account the opportunity cost of having that money, tied up in the machine over the course of a year where it could be earning that interest rate. Second year, you're going to get that same amount, again, discounted to the present by 1 plus I squared, all the way to the nth year. So you're going to get, again, that same amount discounted to the present by 1 over 1 plus I raised to the nth power. And of course, you're also going to get a scrap value at the end of that nth year that also needs to be discounted to the present. So the cost of the machine is simply the purchase price, PK. The firm should buy the machine if and only if the present value is greater than or equal to the price. So obviously, if the overall benefit of having the machine is greater than what you're going to pay for it, the firm should buy the machine. If not, the firm should not buy the machine. Since PV is inversely related to I, since the present value is inversely related to the interest rate, meaning that if the interest rate is higher, the present value will be lower and vice versa. Then, as with the firm that rents its equipment, the firm that owns its capital will want to employ more of it the lower the market rate of interest is. So the lower the firm can get in a return by just investing in basic assets in the markets, the more it should invest in production and earn more money that way. Quick practice problem. Suppose a machine generates $121 worth of revenue at the end of each of the next 2 years, at which time it can be sold to a salvage company for $242. If the annual rate of interest is 10%, what is the maximum amount a business would pay for the machine? All right, so we're looking at here 2 years. The revenue is $121 at the end of each of the next 2 years. We have a maintenance fee of 0. And we have a scrap value of $242. So again, we're going to compare the price to the present discounted value of the income stream that the machine can generate. And the interest rate is 10%. So again, we've got our formula here. So that first year, again, there's going to be $121 in revenue, minus 0 in maintenance fees, and discounted to the present by 1 over 1 plus 0.1 raised to the first power. So that's the discount factor that we're discounting $121 to the present with. Getting that same amount that second year, $121 2 years in a row, discounted to the present by 1 over 1 plus 0.10 raised to the second power to denote the fact that, again, that's 2 years in the future. So we're discounting it twice by 1 over 1 plus 0.1 raised to the first power. And of course, we've got that scrap value of $242 at the end of the second year, also discounted to the present by the same discount factor as 121. So this winds up equaling 110 plus 100 plus 200, which is equal to $410. All right, so the question then is, what is the maximum amount a business would pay for the machine? $410, right? As long as the benefit is equal to the cost, they'll buy it. But if the cost is higher, if it's $411 and the benefit is $410, they won't buy it. So If the purchase price is 400, should the firm purchase this machine? Yes, exactly. So we've got 410, which is greater than 400. So the firm should purchase the machine. All right, so let's lightly touch upon issues related to the interest rate. So obviously, there's a lot of different interest rates in the world, but the most important ones are the ones set by central banks. So the central banks set the federal funds rate, which is the rate at which banks can lend to each other overnight to make sure that they're meeting their reserve requirements. And essentially that is like the baseline short-term interest rate that kind of determines how all other short-term interest rates are going to move. And then there's long-term interest rates, and long-term interest rates wind up being sort of like an average of what people expect to happen to short-term interest rates. So long-term interest rates are dependent on what's happening with short-term interest rates, both in the present and in the future. But of course, the future is uncertain, and so there's expectations of the interest rate based on, maybe patterns of things that have happened in the past, or signals that we're getting from the economy, from central banks, etc., that might give us an indication of how the interest rates will change. But again, it's uncertain, so we can only have expectations about the interest rate, and how we set expectations is tricky. How do we model those expectations? Well, there's a lot of different approaches, and it's often a contentious point because, again, we don't exactly know what's going to happen, and that's ultimately what happened in 2008, where economists were like, yeah, everything's fine, and then it wasn't, and then it all fell apart because, again, like animal spirits, like that part of the economy that is dependent on the people part of the economy, where oftentimes we'll do crazy things, like we'll elect a billionaire to office who is just going to look out for his billionaire buddies and not everyone else. So the world is weird, and so again, that's why our discipline is an art and not a science, because ultimately it's difficult to say what people are going to do, and we have to take into consideration what's happening in the future as well as what's happening in the present. To understand what's happening in the future, we have to make estimates about interest rates and prices, etc., and that, who knows ultimately, right? So we can be as precise as possible in claiming we know, but ultimately we really don't. But it's good to just have some kind of formal framework to try to have an idea, because if you don't even try, then nothing's happening. Anyway, let's look at a very sort of basic way that interest rates can be thought of to be determined. So there's this thing, it's sort of this abstract concept that we use in economics. It's called the loanable funds market, and it's just a way of sort of thinking about how interest rates can be determined using our supply and demand framework, but there isn't actually one, obviously, market for loans that mirrors the model that we're going to look at right now. So the loanable funds market is an almost literal embodiment of the ideal of a perfect, homogeneous, standardized product. So it winds up being a competitive market in the way that we analyze it. The result is a national, indeed international market for loanable funds in which the interest rate charged to a given type of borrower is virtually the same everywhere. So the loanable funds market is a standard market model, price on the y-axis, quantity on the x-axis. The price of the funds is the interest rate. The price to borrow is the interest rate. So the firm's demand for capital tells us how much capital it would like to employ at a given rental rate of capital. So we know the interest rate plays into that. So one of the participants in these markets is firms borrowing money from banks. A firm's demand for capital is its demand for loanable funds. At the industry level, the demand for loanable funds is the difference between the amount of capital firms as a whole would like to have and the amount that they already have. Firms are not the only borrowers, obviously, in the loanable funds market. Consumers borrow to finance the purchase of houses and other goods. Governments also play a huge role in borrowing, obviously, to build roads and schools and to finance general budget deficits that result from huge tax cuts. The demand curve for loanable funds is the horizontal summation of the demands from all these sources. So that's sort of the way to theoretically think about like this demand curve as sort of an aggregate of all demand for all loanable funds from all participants in the economy. On the other side of these markets is the supply of loanable funds. Obviously, generally it's going to be savings, right? Like people, savings are put into banks and they act as financial intermediaries, funneling people's savings to those that need them. So on the supply side, there's also multiple sources of loanable funds. Consumer savings supplement funds made available by firms out of profits. So again, like that is a way to sort of add to the extra funds available in these markets by consumers, but firms' profits do tend to also serve as a basis for lending. The theory of consumer behavior, though, tells us that a rise in interest rates may either raise or lower consumer savings. So it can go either way. I'm not going to get into the specifics of it because I would need to talk about the rational consumer choice model, but again, interest rates might cause consumers to behave differently depending on their preferences. And so we can't necessarily say that the upward sloping supply, meaning that as the interest rate goes up, people supply more loanable funds, is directly related to the behavior of consumers. Because again, theory alone does not tell us which will dominate. For savings by private firms, the quantity of loanable funds supplied by firms will respond positively to interest rates. So the amount that is available in these markets, that is the savings of firms that represent their profits, will increase as interest rates increase. But most foreign lenders are happy to supply funds to U.S. borrowers whenever the interest rate meets or exceeds what they can earn at home. So we talked about that in my macro course, but obviously in your macro courses as well, that the interest rates internationally are often what drive movements in exchange rates, because international investors are often just looking for the highest return, and they obviously need the country currencies to be able to either invest or save in those countries. So they need to exchange their currency for the domestic country's currency that they're saving in. So increased interest rates in a particular country will increase the demand for a particular country's currency, which will increase the relative price of that currency to other countries, which will make the goods in that country more expensive, but it'll make the goods in other countries less expensive. Anyway, ultimately, it is these international borrowers that are mainly responsible for the upward sloping supply of loanable funds. So the large size of foreign lending in recent years suggests that this source is responsible for most of the elasticity we see in the supply curve of loanable funds. Adding all sources of supply horizontally, we obtain the aggregate supply curve of loanable funds. All right, so we have a supply, we have a demand, and obviously they intersect the equilibrium, which sets the equilibrium interest rate. So it's a way of sort of thinking about how an interest rate can be determined and how that interest rate might be affected by movements in savings on both the side of firms and consumers and governments and international borrowers and lenders. Of course, we do have to take into account the fact that borrowing is generally going to be done in nominal terms, meaning that the amount of the return is going to be set as just a number that is not going to be adjusted for inflation, and sometimes prices are going to oscillate when we have either inflation or deflation. And so that return in real terms, in terms of what it can actually buy, may not accurately be reflected in the nominal amount that's stated in contracts. So let's look at why that is and how the inflation rate can play a role in setting what are called real interest rates, which are the ones that actually matter. So suppose you borrow $1,000 from a bank, which you agree to repay in a year's time at 5% interest. Suppose that once the year passes, the overall price level in the economy, though, has risen by 10%. The question then becomes, what is the real cost to you of the loan? So to answer the question, imagine that when you first borrowed the money, you used it to buy, let's say, 100 ounces of silver at 10 cents an ounce. In a year, the silver can be sold for $11 an ounce, since the price has increased by 10% of 10, which is $1. The proceeds from the sale will be $1,100 or $50 more than the $1,050 you need to repay the bank. So again, you borrowed $1,000 at 5%, so you have to pay them $50 at the end of next year. The real cost to you of the loan, measured in dollars on its due date, is therefore negative 50. So again, like you have the negative 50, meaning that that's profit to you. So again, you have that $1,100 that you make from selling them, and then you have to get rid of those $50 in interest in repayment to the bank, which leaves you with $50 in profit. So on the reciprocal end of the transaction, the bank that loaned you the money came out $50 behind. When banks expect the overall level of prices to rise, they will charge an interest premium to counteract the erosion of the real purchasing power of future loan payments. So generally, even though we do just see nominal interest rates on loan contracts, those will generally take into account expectations of what will happen to the real interest rate, what will happen to inflation, the overall price level in the market, so that banks don't come out losing the way they have here. So the actual number that appears on a bank loan contract is the nominal rate of interest. If N denotes the nominal annual rate of interest expressed as a fraction, and Q denotes the annual rate of inflation also expressed as a fraction, then the real rate of interest is given by this term here, where you have the nominal interest rate minus the rate of inflation over 1 minus the rate of inflation. In your macro class, you probably just learned this as I equals the nominal interest rate minus the real interest rate. Minus the inflation rate. So the real interest rate equals the nominal rate of nominal interest rate minus the rate of inflation is how you probably learned it in your introductory courses. That actually winds up just being a good approximation to this expression that is a little bit more accurate if you actually do the numbers behind it. But when the rate of inflation is small, so you have like a really small amount, then this number is close to 1. So this essentially does wind up equaling N minus Q. The nominal interest rate minus the rate of inflation will give you the real interest rate. All right, let's talk about the market for stocks and bonds, the financial markets. So one common method by firms to buy capital equipment is to raise money for new investments by issuing corporate bonds. All of you likely know what bonds are. They're debt instruments. They're basically promises to pay back. Governments and private entities issue bonds whenever they need money. We're trying to build a high-speed bullet train in California that's largely being funded by these bonds that are being sold right now. So hopefully that'll happen soon. We're going to have a bullet train that's going to get us to San Francisco like within an hour or something, which is nuts. I hope it actually happens, but we'll see. Anyway, so there's different types of bonds. I know you finance people know all of this. You probably know more than I do, but probably not. Anyway, so there's different aspects to bonds. There's the face value of a bond, which is the amount for which it was sold to the investor who bought it from the firm. There are short-term bonds, which often promise to return their face value in full within 90 days, often called discount bonds, because they don't pay what are called coupon payments, which is, again, like a predetermined payment that's made for an extended period of time, however long the duration of the bond. Many long-term bonds reach maturity only after 30 years, and some have even longer lifetimes. So the government, our federal government, issues 3 different types of bonds generally. The actual bonds, the treasury bonds, are the 30-year bonds, but then you've got the treasury notes, which are 10-year, and then you've got the treasury bills, which are less than 1 year. The treasury bills are discount bonds. They only pay you they pay you the face value at the end of the year. The coupon, the notes and the bonds are coupon bonds, and they pay you a certain amount at the end of every year, and then a face value at the end of the year, at the end of the maturity period. Once bought, bonds are, of course, traded. So obviously you can buy a 30-year bond, and you're not going to hold on to it for 30 years. It's going to have a going rate on markets. So short-term bonds sell for close to their face value generally. Long-term bonds can differ a lot from the face value because, again, long-term bonds will have those coupon payments that are part of the value of those bonds, and they need to be taken into consideration. Suppose the market rate of interest is 10% when an investor buys a $10,000 bond from a corporation. The bond promises to pay her $1,000 a year interest for the next 30 years, so that's the coupon payment, and then return her $10,000 in full, which is the face value. As long as the interest rate remains 10%, the bond will continue to be worth the $10,000. The annual return compensates for the opportunity cost. Suppose the interest rate, though, were to fall to 5%. So the going interest rate in markets falls to 5%. The annual opportunity cost then falls from $1,000 a year to $500 a year. The investor holding the bond will now want to be compensated for the extra return that the bond is able to offer. How much a buyer will pay for the bond will depend on how close the sale is to the due date, where the bond will be worth only the $10,000, the face value. There are special kinds of bonds that pay out in perpetuity, forever. They are called consols. So a consol is a bond for which the face value has no bearing on the current price because they are promised a payment indefinitely into the future. A perpetual bond or consol bond is a bond that pays a fixed payment each year in perpetuity. The current market price of a consol is the amount of money that would be needed at the current interest rate to generate the same amount of interest as is paid by the consol. If we let I represent the consol's annual payment, and that's capital I, and little I represent the market rate of interest, then the price of a consol will tend to be the difference between the coupon payment, which is I, divided by the capital I, divided by the interest rate, which is I. So this is just a sum of the present discounted value of each of those payments into the indefinite future. When you have that kind of infinite sum, it converges via what's called a geometric sum, a limit of a geometric sum, something you might learn in algebra calculus 2 if you decide to take calculus 2. And that's how you would derive this. So consols are priced in this way. There aren't a lot of consols. It's not a common thing. The British government issued some during the Napoleonic Wars, like in the early 1800s, and they're still around today. So you'll still find some of these in markets. Really kind of weird old artifacts of the past that probably deserve to be in museums, but are just being traded. Quick practice problem. Consider a perpetual bond that pays $120 a year to its owner. By how much would the price of this bond rise if the interest rate fell from 10 to 5%? So again, you've got the price of the consol when the interest rate is 10%. It's, again, the coupon payment, the yearly payment, $120 divided by the interest rate, which is equal to $1,200. And then the price for the consol, if the interest rate were to fall to 5%, is equal to $120, the coupon payment, divided by the interest rate, which is $2,400. So the price of the bond increases by $1,200. So the variation, the price of these consols can be very large. Again, firms have the right to issue these kind of bonds to finance their purchase of real capital, but it is a rare thing today. All right, as we know, governments issue bonds as well with varying interest rates from other bonds. They tend to have the lowest interest rates for obviously the most secure governments. The U.S. government enjoys the lowest interest rates because everybody assumes that we'll be able to pay back. But if you see countries like Greece and Spain was having some problems, and Ireland was having some problems over the last 10 years post the financial crisis, their cost of borrowing went up significantly because there was danger that they would be defaulting on their government bonds. And so obviously governments required what's called a risk premium, an extra amount above the safest return to compensate for the risk. So the general rule is the greater the risk is, that a borrower will not repay a loan, the greater the interest rate the borrower will pay. United States government bonds carry the lowest risk of default available in the bond market. So again, the risk premium is the payment differential necessary to compensate the supplier of a good or service for having to bear the risk. If bonds pay, let's say, 5% and a corporate bond pays 8%, then the risk premium on the corporate bond is 3%. Corporate bondholders do not own a stake in the firm, as you know. They are simply just promised to be paid back with interest, the money that they essentially lent the firm by buying their bond, right? They're not actually laying claim to any of the profits of the firm. The corporation stockholders are the only people who actually own it. A firm that wants to raise money to invest in capital equipment can hire a broker to arrange a new issue of stock certificates. The broker then prepares a description of the firm's investment proposal and, with the cooperation of a network of other brokers, offers the new stock for sale to the public. If a firm, let's say, sells 1 million shares of stock, then each share constitutes a 1/1 millionth of the claim against 1/1 millionth of the current and future profits of the firm. So stock prices are essentially a discounted present value of the profit stream of the firm divided by the number of stocks that exist. Profits may be distributed to shareholders directly in the form of dividends, or they may be reinvested in the company, which will increase the value of the company's future profits. The stock price reflects, again, the present value of the current and future profits. Suppose the present value of the current and future profits of the 1 million share hypothetical company is known with certainty, and let's say it's $500 million. Then the stock should be traded for, again, 1/1 millionth of that, which winds up being $500 a share. Seldom is a company's future profit stream known with certainty, though. Again, when we're calculating these things, we have to take into account future interest rates. What are those? I don't know. You don't know. But we can do what we can to sort of try to ballpark it, given, again, the history of interest rates in relation to economic conditions that may fluctuate depending on, whatever kind of signals we can gain from the economy. So the value of a firm's income stream varies significantly across firms. Also, you don't know how much the firms are actually going to make. You don't know if those contracts that they have into the future that suggest a certain profit stream will actually come to fruition. Consider two firms with the same expected value of current and future profits. The present value of firm 1's profit stream, let's say it's 100 million with certainty. The present value of firm 2's profit stream, by contrast, has a 50-50 chance of being either 200 million or zero. So therefore, we have to take an expectation of the present value. There's 1/2 probability that the firm will earn the 200 million, or there's a 1/2 probability that the firm will earn zero. So we take a weighted average of those possible outcomes, weighted by their respective probabilities of occurring. In this case, it's $100 million. So if the stock prices of the two firms were the same, the question is, which one would you prefer to buy? So most people ultimately will depend on how risk averse they are, or how risk loving they are. If you remember chapter 6, we talked about how we can specify the attitude towards risk in our utility functions as a way of sort of capturing that attitude in the pricing model of a particular instrument or a particular industry. Most people are risk averse and thus prefer to invest in firm 1, which is less risky, generally making the trading price of riskier firms lower by comparison. So again, the riskier firms are going to wind up with a lower price, much like a riskier bond is going to require the firms to pay out greater amounts of money to compensate for the risk. This is called the equity premium, by the way, when it comes to stocks. The same logic leads to riskier bonds needing higher interest rates of return. As an investor confronting the stock market, you face a budget constraint like the curve labeled BB. So this is sort of this kind of weird budget constraint where the opportunity cost of safety versus return. So basically, the price of safety is if the instrument is a safe one, then the relative price is going to be low. But I'm sorry, if the safety is greater, then the relative price is going to be higher for the compensation for that instrument will be higher than if it was not safe. And so this is the budget constraint, and these are the indifference curves of folks that are either less cautious and therefore more risk-loving and more risk-averse. And so the marginal rates of substitution, the rate at which they're willing to trade off expected return for safety, is going to be low for the less cautious investor and high for the more cautious investor, which means that, again, the more cautious investor, the risk-averse one, is going to wind up purchasing the safer assets, where the risk-loving investors are going to wind up buying the less safe and higher return assets. So there's just this hypothesis that most investors ultimately just care about expected return, and that safety is not a big deal to them, which is one that is prevalent because of the fact that, we often see like the riskiest of behavior kind of spiraling out of control, which leads to crises in the economy, and that always happens if there are no sort of protections in place to kind of stop that from happening. So whenever you kind of let it go on its own, that's when it kind of happens, and that just tells us that in general, investors are willing to just focus only on expected return. And so even though most people in general are risk averse, investors tend to be ultimately risk loving. Like they will, jump on the most highly returnable assets. So investors with relatively low marginal rates of substitution between return and safety will choose risky investments such as A. Those with higher marginal rates of substitution between return and safety will choose safer investments such as those on C. All right, and finally, let's look at this one sort of concept called the efficient market hypothesis. Most economists believe that the stock market is efficient, that the stock market itself is able to satisfy everybody that is interested in buying and everybody that is interested in selling. Like there isn't a lot of inefficiency due to market power, so most markets do tend to be competitive. This means that the price of a stock embodies all available information that's relevant to its current and future earnings prospects. Critics of the efficient market hypothesis often object that it refers to a frictionless ideal world in which essentially all information is immediately transmitted to everybody that needs it, and that immediately translates into the price of the asset, and so therefore there aren't any possibilities of getting an expected return kind of just lying around. Since information about new profit opportunities usually emerges gradually, many observers erroneously conclude that the market's response to the new information is also gradual. Thus, the critique is misinformed. In the real world, it's usually hard to quantify exactly what information becomes available at what times. Plus, information can be interpreted in different ways. For this reason, it's difficult to empirically prove that the efficient market hypothesis is correct. So even though it's a consensus amongst economists that there aren't opportunities to get a return just kind of lying around, again, that is something that is often sort of criticized by market participants that are not economists. And I think that's just more based on optimism, but there are ways of justifying it. Economists believe that it to be true because the alternative is unrealistic. The one belief that economists hold more deeply than any other is that the only way to reap such gains is by some combination of talent, hard work, and luck. If we deny the efficient market hypothesis, there can be cash just sitting on the table for the taking. There's an ample supply of people who would be delighted to earn their livings in this painless way, but obviously that just isn't the case. Anyway, so that's it, folks. That's it for this chapter. That's it for the second to last chapter of the course. We only have one more chapter to go, one more lecture to go. This weekend is pivotal for you guys, folks. pivotal. Like, do not drop the ball. You are studying for finals now. You're not studying for finals next weekend. You're not studying for finals the night before. You're studying for them right now. If you do that right now, you're going to have a big smile on your face come 2 weeks from now. Have a good weekend.